Traders War Room, we locked and loaded.
What is up, team? Chuck with Traders War Room, and I'm back at you with another video. Guys, we got your tech video today, and today we're going to go over debt trading. What is this, why it matters, and what's important about it. And it's gaining a lot of steam right now, especially with the market being so volatile and, just kind of turning on a dime with 180 reversals, so on and so forth. So I want you guys to be informed, man. As TWR market warriors, our job is to have all arsenals at our disposal, so when we go out there to destroy the marketplace, we're ready for battle, guys. So as always, if you're ready, follow me and let's go to war together. Let's get into it right now.
Hey, something wrong with you if you say we ain't tight. Get in and get out before you think twice. Let's have a toast, you bring the drinks and I'll bring ice. Defeat's nice in the Traders War Room.
We're gonna go over debt trading. What is this and why it matters?
First, you're probably asking, why trade debt? Well, investments in debt securities typically involve less risk than equity investments and offer a lower potential return on investment, hence the lower risk. Debt investment by nature fluctuates less in price than stocks. Even if a company is liquidated, bondholders are the ones that get paid first. Before we dive deep into the debt trading aspect, I want to talk about the difference between debt and equity markets. Debt markets and equity markets are broad terms of two categories of investments that are bought and sold. The debt market, or the bond market, is the arena in which investments and loans are bought and sold. There is no single physical exchange for the bonds. Transactions are mostly made between brokers or large institutions or by individual investors. The equity market, or the stock market as we know it, is the arena in which stocks are bought and sold. The term encompasses all of the marketplaces such as the New York Stock Exchange, the NASDAQ, the London Stock Exchange, so on and so forth. So now that we know that trading debt is the bond market, let's understand the bond market. Often called the debt market or fixed income market or credit market, is the collective name given to all trades and issues of debt securities. Governments typically issue bonds in order to raise capital to pay down debts or fund infrastructural improvements. Note that corporations issue bonds for similar projects improvements as well. So let's understand the bond market. The bond market is broadly segmented into two different silos, the primary market and the secondary market. The primary market is frequently referred to as new issues market, in which transactions strictly occur directly between the bond issuer and the bond buyer. In essence, the primary market yields the creation of the brand new debt security that have not previously been offered to the public. In the secondary market, securities have already been sold in the primary market and then bought and sold at later dates. Investors can purchase these bonds from a broker who acts as an intermediary between the buying and selling parties. These secondary market issuers may be packaged in the form of pension funds, mutual funds, and life insurance policies, among other products and service structures. We'll talk about trading life insurance at a later date. There is huge money in that particular field. Now, I would be doing you a disservice if I didn't take you back to school and give you the history of bond markets. So, bond markets have been traded for longer than stocks have. In fact, loans that were assignable or transferable to others appeared as early as ancient Mesopotamia, where debts dominated in units of grain weight could be exchanged among debtors. In fact, the recorded history of debt instruments dates back to 2400 BC via a clay tablet discovered at Nippur, now present-day Iraq. This artifact records a guarantee for payment of grain and lists the consequences if the debt was not repaid. Literally, we are talking about this type of market being available since the cradle of civilization, people. Continuing with history, later in the Middle Ages, governments began issuing sovereign debts in order to fund wars. In fact, the Bank of England, the world's oldest central bank still in existence, was established to raise money to rebuild the British Navy in the 17th century through the issuance of bonds. The first U.S. Treasury bond, two, were issued in help to fund the military, first in the War of Independence from the British Crown, and again in the form of Liberty bonds to help raise funds for World War I. The corporate bond market is also quite old. Early chartered corporations such as the Dutch East India Company and the Mississippi Company issued debt instruments before they issued stocks. These bonds were issued as guarantees or sureties and were handwritten to the bondholder. Here's what some of the old school bonds used to look like. Look at that. Now, trying to get our generation nowadays trying to read this type of cursive would be almost impossible. But one of the reasons why we use cursive and we still need to know it is so that we can read historical documents like this. Here's what bonds typically look like nowadays. Now let's talk about the types of bond markets. So the general bond market can be segmented into the following bond classifications, each with its own set of attributes. Note, there's many different type of options when you're talking about the bonds. First type we'll talk about is corporate bonds. Companies issue corporate bonds to raise money for a sundry of reasons, such as financing current operations, expanding product lines, or opening up new manufacturing facility. Corporate bonds usually describe longer-term debt instruments that provide a maturity of at least 1 year. Corporate bonds are typically classified as either investment grade or high yield. Another term for high yield is junk. This categorization is based off of credit rating assigned to the bond and its issuer. An investment in grade rating signifies high quality bond that presents a relatively low risk of default. Bond rating firms like Standard & Poor's, Moody's use different designations consisting of the upper and lower case letters, A or B, to identify a bond's credit quality rating. Now let's talk about those junk bonds, right? Junk bonds that carry higher risk of default than most other bonds issued by corporations and government. Junk bonds represents bonds issued by companies that are financially struggling and have a high risk of defaulting or not paying their interest payments or repaying the principal to the investors. Junk bonds are also called high-yielding bonds since the higher yield is needed to offset any risk by the default. So high risk, high reward. These bonds have credit ratings below BBB from the S&P or below Baa3 from Moody's. Let's get into government bonds. National issued government bonds or sovereign bonds entice buyers by paying out the face value listed on the bond certificate on the agreed maturity date, while also issuing periodic interest payments along the way. This characteristic makes government bonds attractive to conservative investors because sovereign debt is backed by government that can tax its citizens or print money to cover the payments. These are considered the least risky type of bonds. But you got to understand, low risk equals low reward as well. So in the U.S., government bonds are known as treasuries, and by far the most attractive and liquid bond market today. A treasury bill or T-bill is a short-term U.S. government debt obligation backed by the Treasury Department with a maturity date of 1 year or less. A treasury note is a marketable U.S. government debt security with a fixed interest rate and a maturity between 1 and 10 years. Treasury bonds are government debt securities issued by the U.S. federal government that have maturities greater than 20 years. Note the different terms utilized for the different type of bonds: bill, note, and regular bond. Another type is municipal bonds, commonly abbreviated as MUNI, right? Are locally issued by states, cities, and special purpose districts, public utility districts, school districts, publicly owned airports, seaports, and other government-owned entities that seek to raise cash to fund various projects. Munis are commonly tax-free at the federal level and can be tax-exempt at state or local levels too, making them attractive to qualified tax-conscious investors. So munis come in two main types: general obligation bond, which is issued by government entities and not backed by revenue from a specific project, such as a toll road. Some GO bonds are backed by dedicated property taxes. Others are payable from general funds. A revenue bond instead secures principal and interest payments through the issuer of sales, fuel, hotel occupancy, or other taxes. When a muni is a conduit issuer of bonds, a third party covers interest and principal payments. Mortgage-backed bonds. Now, note, caution, there's a lot of high risk associated with these type of bonds, but the MBS's issues, which consistent of pooled mortgages on real estate properties, are locked in by the pledge of particular collateralized assets. The investor who buys a mortgage-backed security is essentially lending money to homebuyers through their lenders. These typically pay monthly interest. MBS is a type of asset-backed security, and this became glaringly obvious in the subprime mortgage meltdown in 2007-2010, where a mortgage-backed security is only as sound as the mortgages that went back it up. Now, these MBSs are a type of asset-backed security, and this became glaringly obvious in the subprime mortgage meltdown in 2007 to 2010, when a mortgage-backed security is only as sound as the mortgages that it backs up. Any of you guys remember that one? Now let's talk about the emerging market bonds. These are bonds issued by governments and companies located in emerging market economies, providing much greater growth opportunities but also greater risk than domestic and developed bond makers. These are the babies, the new ones. Throughout most of the 20th century, countries with emerging economies issued bonds only intermittently. In the 80s, however, then Treasury Secretary Nicholas Brady began a program to help global economies restructure their debt via bond issue, most dominated in the US dollar. Many countries in Latin America issued these so-called Brady bonds throughout the next 2 decades, marking an upswing in issuance of emerging market debt. Today, bonds are issued in developing nations and by corporations located in these countries all over the world, including from Asia, Latin America, Eastern Europe, Africa, and the Middle East. Now, the risks of investing in emerging market bonds includes the standard risks that accompany debt issues, such as variables in the issuer's economic or financial performance and the ability to the issuer to meet payment obligations. These risks are heightened, however, due to the potential political and economic volatility of developing nations. Although emerging countries overall have taken great strides in limiting country risks or sovereign risk, it's undeniable that the chance of some sort of instability is more considerable in these nations than developed countries, particularly the U.S. Now, emerging markets do pose other cross-border risks, including exchange rate, fluctuation, and currency devaluations. If a bond is issued in a local currency, the rate of the dollar versus that currency can positively or negatively affect your yield. When the local currency is strong compared to the dollar, your returns will be positively affected, while a weak local currency adversely affects the exchange rate and negatively affects your yield. We're seeing this now with the dollar being so strong on the global economy. Bond indices. Just as the S&P 500 and the Russell indices track equities, big-name bond indices like the Bloomberg Aggravated Bond Index, the Merrill Lynch Domestic Master, the Citigroup U.S. Broad Investment Grade Bond Index track and measure corporate bond portfolio performance. Many bond indices are members of broader indices that measure the performance of global bond portfolios. On that line, the Bloomberg, formerly the Lehman Brothers Government Corporate Bond Index, also known as the AGG, is an important market-weighted benchmark index. Like other benchmark indexes, it provides investors with a standard against which they can evaluate the performance of a fund or security. As the name implies, the index includes both government and corporate bonds. The index consists of investment-grade corporate debt instruments with issues higher than 100 million and maturities of 1 year or more. The AGG is a total return benchmark index for many bond funds and exchange-traded ETF funds. Here's some popular tickers for bond ETFs: AGG, TLT, Bond, VCLT. You can also do a simple Google search and check out tons of bond ETFs out there.
In the traders war room. Warring with the market every day, we on Zoom. Never gonna quit, ain't no way we gonna lose. I done made a profit and it's way before noon. Way to go, dude, come and learn how to trade stocks. We rentless with the attack when this thing pop. We market warriors and we can share the same pot. I woke up and went to war in my tank top.
Because of the legal projections and guarantees in bonds stating repayment to creditors, bonds are typically less risky than stocks and therefore commonly lower expected returns than stocks. Stocks are inherently riskier than bonds and so have a greater potential for bigger gains and bigger losses. Both tend to be very active and liquid. Bond prices, however, tend to be very sensitive to interest rate changes, with their prices varying inversely to interest rate moves. Stock prices, on the other hand, are more sensitive to changes in future probability and growth potential. Have you noticed how, CPI data, for example, right, coming in hot will push the bond rates up and it makes stocks dump, especially the big cap ones, the Apple, the Microsoft, the Teslas, so on and so forth. Like it said, it kind of works inversely on the sensitivity of what's going on with the global or the economy as a whole. So let's get into some pros and cons of the bond market, right? So most financial experts recommend that a well-diverse portfolio have some allocation to the bond market. Bonds are diverse, liquid, and less volatile than stocks, but they also generate lower returns over time and carry credit and interest rate risk. Therefore, owning too many bonds can overly conservative over long time of the horizon, meaning basically you own too many of these over the long haul, you're not going to be making as much money. So some of the pros: bonds tend to be less risky and less volatile than stocks. Wide universe of issuers and bond types to choose from. The corporate and government bond markets are among the most liquid and active in the world, and bondholders have preference over shareholders in the event of a bankruptcy. Some cons are lower risk translates to lower returns on average. Buying bonds directly may be less accessible for ordinary investors, and exposure to both credit default risk as well as interest rate risk. So a common question is like, well, if they're so low risk, can you lose money in the bond market? Well, yes. While they're not as risky as stocks on average, bond prices do fluctuate and can go up or down. If the interest rate rises, for example, the price of even a highly rated bond will decrease. The sensitivity of the bond's price to the interest rate change is known as duration. A bond will also lose significant value if the issuer defaults or goes bankrupt, meaning it can no longer repay in full the initial investment nor the interest owed. So with all of this information that you now have at your disposal, how do we make money from debt trading? There are two ways that investors make money from bonds. The individual investor buys bonds directly with the aim of holding them until they mature in order to profit from the interest they earn. They also buy into a bond mature fund or bond exchange ETF. In the secondary market, where the amount of the discount depends partially on how many payments are still due before the bond reaches maturity, it is priced also to bet on the direction of the interest rate. So if the trader thinks that a new issue will be lower, then it might be worth a little bit more at the end of the maturity. The owner of the bond receives interest payments, known as the coupon, through the life of a bond and the interest rate that was determined when it was issued. An example would be you invested $1,000 in a 10-year bond with a coupon of 4%. The issuer would send you a coupon interest payment of $40 every year. Most bonds pay twice a year, so you'd get a check for $20. Now, this may not seem much for, buying one bond, but normally when you buy bonds, you're either buying repetitive bonds, such as you buy a new bond, a 4-week bond. Every week you buy a new 4-week bond, and they keep cycling and maturing over and over and over. Or every so often you buy a bond, you buy 10 bonds here, you buy 10 bonds there, you buy 10. So over time, you're buying more and more bonds, increasing the amount of interest that you're paid over the long haul. Now I want to talk about the coupon that we just said, because it's a little term that you may not be used to, right? So coupon paying versus zero coupon bonds, right? So coupon paying bonds are a frequent choice of older investors and retirees who value the steady income or the fixed income that payments provide and the relative safety of bonds as an investment. Those short-term treasury bills have the same benefit as reliable income supplements and safe investments. The long-term zero-coupon bonds hold little attraction for most older investors and retirees who are unlikely to want to tie up their money for decades. However, younger investors looking for long-term savings or wealthy investors looking to pass inheritance have more an interest in these type. Let's dive into the zero coupon bonds real quick. So investors in zero coupon bonds receive no payments for their money until the bond matures. They buy the bond for an amount that is less than its face value. When it reaches its maturity, they are paid the full face value of the bond. The zero coupon bond, also known as a discount bond, U.S. Treasury bills, and U.S. savings bonds are two examples. And these are relatively very safe investments that you've always heard the old school, they would buy their grandkids a few bonds and stuff like this, get them a 20, 30-year bond, and they'd come to maturity by the time they were adults so that they could utilize it for college or a house or something like that. So wrapping this up, guys, the bond market is among the largest asset markets in the world, almost twice as large in terms of notional value as the stock market. The bond market includes debt securities issued by governments and corporations, both domestic and foreign. Bonds may also be structured with fixed or variable interest rates and may or may not be convertible into equity. Bonds are typically thought to be less volatile than stocks since they pay regular interest and return principal upon maturity. However, the bond market can lose value and credit risk exists. Most financial professionals advise you that all investors contribute at least some portion of the portfolio to bonds to help diversify. All right, team, that's it for today. I hope I provided you some value and worth that you got out of this. Don't forget, you can come and get some with the Bulls at Traders War Room and join the team and come trade with me. Right now, you get everything we offer, all the live trading, all the algos, all the alerts, everything we have, over 100 channels, 30 analysts, and just something for everybody, guys. Join us today and come and get some. As always, let's go to war, and all the links to join are in the description.
Come join it in the Traders War Room. Warring with the market every day, we on Zoom. Never gonna quit, ain't no way we gonna lose. I done made a profit.